I think there are three parts of the near-term metrics that are decelerating, and that's what investors have been focused on all day long. And those are, number one, the daily active user growth. Just that's 9%, and but when you put that in the context of MAUs, which are declining, and so the question is, can they reaccelerate that user growth? I think the second one is just revenue. So revenue was really good for the fourth quarter, but people want to know, will that continue to be strong? Can it reaccelerate? And then the third one, which is the biggest one, is expenses, right? So the company is guiding us as analysts towards more spending in 2019 on health and security. And so that's compressing margins in the near term. And those are really three things I've been talking to investors about all day.
And Anthony, we know there are similar issues with Facebook and Instagram and trying to basically staff up and police their content. Why is this worse for Twitter? And does it raise existential questions for them again about needing a buyer?
So your question, I don't really think it is worse for Twitter. I think that this is an example where expectations of us, of analysts going into this outlook for the year, were elevated going into the call. I think if you just take a step back and you look at operating expenses are growing about 20% year over year for Twitter, it's actually much lower than operating expense growth for Facebook, for example. And so, I don't think I just think it's a little bit versus elevated expectations. I actually think that for Twitter, because the scale and the size of the time spent on the platform is much, much less than it is for Facebook, that it is possible that it's more manageable for Twitter, and that once they kind of put some new investments in place, that hopefully they can get back to leveraging revenue back towards profitability in the future.
So is this, Anthony, a case then where investors have to get used to a much lower multiple going forward for Twitter if they keep running into these problems of having to reset expectations?
Look, you asked about, does it need to be sold? I disagree. I think it's a very viable independent company. It has EBITDA and free cash flow and earnings, and so there's not a need to raise capital. So I wouldn't look to that. And I also think there is long-term value here. So you're asking about valuation, and I'd like to say there are riches in niches, in a sense that this is a business where it's not Facebook, it's not Google, it's not the mainstream for 2.7 billion users, but the users that use it, and I'm one of them, are very active, are very intense, are very sort of have this need of what's happening now, real-time news, Trump, global leaders, sports events, right? So it's a very unique use case where the value, I would argue, is compounding over time. The market cap isn't as great, but it's just hard for stocks in the tech world to work in the near term when you have decelerating metrics.
Sure.
So basically on the stock, I would say if it were to trade down another moderate leg, let's just call it 8 to 10%, then I'd be a buyer. But it's the kind of stock where we're price sensitive.